Welcome back to our ongoing deep dive into the property and casualty insurance industry. In our last breakdown, we looked at how executives can use the reserve trap to hide massive losses and fake their current year profits. But even the most honest insurance companies face an existential threat that is completely out of their control. That threat is the underwriting cycle. To understand why insurance companies experience such violent swings in profitability, you have to realize that insurance is fundamentally a commodity. If you are a massive construction firm looking to buy a liability policy, a contract from one insurer looks exactly the same as a contract from another. Because the product is just a piece of paper, the primary way for companies to compete is by lowering their price. This creates a highly dangerous financial environment known as the soft market. A soft market occurs when the insurance industry has simply been too profitable for too long. Institutional investors and Wall Street hedge funds see those massive returns and pour billions of dollars of fresh capital into the sector. Suddenly, you have way too many insurance companies desperately chasing the exact same customers. To maintain their market share and keep their revenue growing, these companies start slashing their premium prices. But it gets worse. They also loosen their strict underwriting standards and begin insuring terrible, high-risk businesses that they normally would have completely rejected. They do this just to keep the premium dollars flowing in the door so they have cash to invest. In the industry, this is known as cash flow underwriting, and it is absolute financial poison. Companies writing these underpriced policies are essentially selling a dollar bill for 90 cents. They can actually get away with this illusion for several years because it takes a long time for complex claims to be filed and settled. The executives collect their massive performance bonuses while the underlying foundation of their company slowly rots away from the inside. The entire market becomes infected with bad policies written at terrible prices. The fundamental discipline of risk management completely vanishes, and the industry marches blindly toward a massive cliff. Eventually, the inevitable bill comes due. The poorly priced claims start hitting the courtrooms, the reserve traps spring shut, and these undisciplined companies realize they are completely out of cash. It is a slow, agonizing bleed that only stops when the entire industry is violently reset by a massive, unavoidable shock. That kind of violent reset is exactly what the industry needs to cure a soft market, and it usually arrives in the form of a massive natural disaster. Imagine a Category 5 hurricane slamming into the coast, causing $50 billion in property damage overnight. Or imagine a severe economic recession that triggers a massive wave of corporate bankruptcies and executive liability lawsuits. When a catastrophic event like this occurs, the insurance companies that were aggressively slashing their prices during the soft market are instantly wiped out. Their surplus capital is completely destroyed, and many of them are forced into bankruptcy. This violent destruction of capital is the catalyst for what the industry calls a hard market. When the weak companies collapse, the supply of available insurance dramatically shrinks. But the demand for insurance remains exactly the same, because businesses are legally required to carry coverage to operate. The surviving insurance companies, the disciplined operators who refuse to underprice their policies during the soft market, suddenly hold all the leverage. Because there is a massive shortage of capital in the market, these surviving companies can aggressively hike their premium rates by 20, 30, or even 50% in a single year. Furthermore, they can tighten their underwriting standards, demanding incredibly strict terms and refusing to cover high-risk clients. The power dynamic completely flips from the buyer to the seller. This is the environment where the greatest insurance franchises print absolute fortunes. In a hard market, they are writing incredibly safe policies at massively inflated prices. Their combined ratios plummet, meaning their underwriting profits skyrocket. The massive influx of new premium dollars generates a tidal wave of free float, which they can then deploy into the investment markets to compound their wealth even further. Warren Buffett has historically used these hard market cycles to aggressively expand Berkshire Hathaway's market share, stepping in to write massive policies when everyone else is terrified and out of cash. The hard market is the ultimate reward for maintaining strict underwriting discipline when your competitors were acting recklessly. However, the extreme profitability of a hard market cannot last forever.
Those massive profits inevitably attract the attention of Wall Street once again.
Fresh capital begins flowing back into the sector, new competitors emerge, and the vicious cycle slowly begins to repeat itself. But today, there is a brand new, highly unpredictable variable that is violently distorting this traditional cycle and terrifying even the smartest actuaries and the most experienced underwriters. It is a completely man-made financial disaster, and it is known throughout the legal system as social inflation.
Now, traditional inflation is a concept every investor understands when it comes to the rising cost of groceries or housing. But social inflation is entirely different. Social inflation is the rapidly accelerating cost of insurance claims driven directly by the legal system, aggressive plaintiff attorneys, and shifting cultural attitudes toward massive corporations. In the past, if a commercial truck was involved in an accident, the insurance settlement might have been a highly predictable $2 million based on historical medical costs and standard legal precedents. Today, that exact same accident is resulting in nuclear jury verdicts of $50 million, $100 million, or even hundreds of millions of dollars. This explosion in claim severity is being fueled by a highly lucrative new industry called third-party litigation funding. Wall Street hedge funds and private equity firms are now treating lawsuits as an alternative asset class. They are directly financing the legal fees for massive class action lawsuits in exchange for a percentage of the final settlement. Because the plaintiffs are backed by billions of dollars of institutional capital, they no longer have to settle early for a reasonable amount. They can afford to drag the insurance companies through years of grueling litigation, taking cases all the way to a jury trial where they use highly emotional psychological tactics to secure astronomical payouts. For the insurance industry, social inflation is an absolute nightmare. It completely destroys their actuarial models. How do you accurately price a commercial liability policy today when a jury might arbitrarily decide to award a nuclear verdict of $200 million 5 years from now? You cannot predict it. To protect themselves, insurance companies are being forced to aggressively raise their prices year after year, fundamentally extending the duration of the hard market. The companies that fail to account for social inflation are falling right back into the reserve trap, realizing too late that the money they set aside is nowhere near enough to cover these massive new legal verdicts.
The true winners in this environment are the massive global insurance fortresses that have the historical data, the elite legal defense teams, and the sheer financial scale to accurately price this escalating litigation risk. They gather this incredibly expensive premium, build massive fortified reserves, and immediately put that capital to work to generate compounding returns. Because at the end of the day, the true magic of the insurance business model is not just collecting the premium dollars from the policyholders. The real secret to building long-term shareholder wealth lies entirely in what happens when that massive pile of money officially enters the investment engine.
And how that engine works is exactly what we are going to dissect in our next video. We are going to open up the hood and look directly at the investment portfolios of these massive financial fortresses. We will explore why insurance companies are heavily restricted by state regulators, forcing them to invest your premium dollars into boring, low-yielding bonds. But more importantly, we are going to break down the exact mathematical anomaly that allows Warren Buffett and Berkshire Hathaway to legally break those rules, invest their massive float directly into the stock market, and completely crush the competition. That is exactly what we are uncovering next here at Start with the A's. We are continuing our masterclass on the property and casualty insurance industry, applying the exact same rigorous analysis used by the best capital allocators in the world. Make sure you hit that subscribe button, check out the rest of the Insurance Primer playlist, and I will see you in the next breakdown.